It's a wonderful opportunity again this afternoon to have you all present. And this moment is not taken for granted. And to start with, my name is Yemi Olaleye. I'm a market analyst at Investlo, and this is your gateway to trading. I've done this several times, and I want to tell you one thing that has been amazing over the years is that no matter what you think that we know as traders, we never know enough when we lack the understanding in the risk management and the psychological parts of the business. And I am glad to tell you that I've been a victim of poor psychology. I've been a victim of emotional roller coaster. I've been a victim of those that could not handle trades very well, but those are the things of the past. It's been years now. I'm still working on myself to be better every single day. So what I'm saying is not that you are in a wrong path, but particularly that you're in a right path that needs constant development. That being said, you're welcome to class today. And today will be about the risk management and psychology. I'll be talking with you this first today, and I'm going to be sharing my thoughts, and I will try as much as possible to make that relatable with you, regardless of where you are, being a newbie or you are already a seasoned or a professional trader, so to say. Risk management on its own is defined as any measure that you put in place to ensure to maximize profit and to minimize losses. To ensure that you can maximize the profit and minimize losses. So ideally, if you have the best trade ever or the best entry ever, that doesn't guarantee your trade to be closed in profit. Do you get me? Sometimes it's also very, very important to know that the best entry doesn't make the best trade. At the end of the day, you should know that. So where am I going with all of this? That your skill sets, technical analysis, fundamental outlook, they are not enough. You need something more, something bigger, something stronger, something you can rely on that is beyond something tangible, visible. That is the risk management. That is the psychology. And good evening. We'll be dwelling on this today for the next couple of minutes. We still have like 46 minutes to talk about this. So risk management, in a nutshell, is any approach or strategy you employ to reduce your losses and increase your profit, or rather to maintain your profit. That is for the advanced traders. They already know what that means. Now, that being said, let me say very quickly that what you're going to close your market with, your trade with, comes from your place of acceptance, and that is from your place of risk appetite. If you're not ready to take losses of more than $1 in the market and you're seeing minus $5, you would already be uncomfortable. And when you're uncomfortable with your trades, you may take nasty decisions. I mean nasty in the sense that you would know that this is not the best decision you can take or that you should take, or you're going to go ahead with it anyways. That means you know already that this is not the best of you, but you're performing, you are sub-optimized, you are performing below who you are as a person. When you look at that, you will see that it is just your emotion drilling you in that direction. So first, understand your risk appetite, what you can let go in the market, what you can let go in that market. Understand that. 2, the backbone of your sustainability in forex trading is risk management. Nothing more, nothing else. Whether you're going to make it big or you're going to lose so much, everything within that sphere depends on your risk management. So when you say, but I have like $1 million in the market, I can't lose it all. Okay, I heard you, but you're not the first to have it, and you may not be the last to blow it, because guys, traders have come and go in this market, having it, losing it, and moving out of the business. So why will you say because you have $3,000, $30,000, 500,000, or $1 million, you cannot lose? The market is still bigger than you, by the way. So all of that is to tell you that there is more to the market than your skill set. By the way, your skill set is very good. You need it at all costs, but it's not the ultimate thing that you need in the market. It's not the ultimate. It's not the ultimate element that will fast track your process, that will fast track your learning curve. It's not the ultimate element that you need for sustainability. It's not in skill set. That is in the psychology, your risk management. All right, quickly, I'll talk about psychology briefly. As you know, psychology is intangible, but you can't deny the fact that they exist. If you say psychology and because you don't see it face to face, you should take it for granted, then you should be ready to dance to the tone of that in the market. When you talk about psychology, it's more of your mental capability, your reactions, how you take this, how you weigh the options, how you decide your thought process, how you think it through. This involves the fear, it involves the greed, it involves the FOMO. FOMO is the fear of missing out. It involves all of this. Now, to the greatest part of that is when you do not understand how to manage and walk around these three important nodes, you're going to be stressed, you're going to be dragged unnecessarily in the market, you're going to be frustrated, because to start with, I will tell you that greed is a necessity for human existence. We have to be greedy, but you should be able to control your greed. I should be able to control mine. That's it. But when you go through the market with the idea that you don't have to be greedy, you will find out that every single time you are just greedy, trying not to be, but you are. And every time that will mess you up. You will understand that you are not supposed to be fearful in the market. You need to develop yourself to a place where you have more confidence. And I will tell you, there's a lot in that. So let me take it step by step so I don't digress too much with certain examples, scenarios that will make you laugh. But let's get going, okay? Let's just keep going. When you're able to control and understand fully well what the fear, greed, and FOMO is, it enables you to trade with zero pressure. Zero pressure. Trading without pressure means you are already ascertained that whatever comes out of this trade, you've accepted. You're going to trade with an understanding mindset that this is not a get-rich-quick scheme. It is not a business to do to make money today and run away tomorrow to Bahamas. It is something you want to do and build legacy on for the next couple of years. Probably you want to even leave this to the unborn children of yours. That's it. It's a mindset. Don't let anyone tell you otherwise. It is a mindset. Do you know the poor guys you see today and the rich guys you see today? Sometimes, most of the times, the difference and the shift in the life started with the mindset. If you think you can't make it, you will really struggle to make it. If you think you can make it, you will find easier ways to make it. That's it. One of you is on this call right now, and I've been a trainer and I've been a mentor to this person for, I think it's over a year now. The person can hear me right now. It's over a year now, and I can tell. Sometimes I'll be wondering, is this guy not tired of listening to my voice every single time? But I know that is just a perfect example of a forest student. It's a continuous learning. Every information becomes new every single day, no matter how long you've heard it, because these are the things you practice every day, and you listening to them again and again renews in your heart, and you realize that you're on the right path or you're getting better. And for the fact that you are getting better, you always try to go back to your source to ensure that you are revitalized every single time. So that is why I know certainly that I can see some people in my class for the next 2 years, for the next 3 years, so long I'm still teaching. And that is how it should be. It's because you have the understanding mindset that this business is not for you to learn anyhow and act anyhow. It's for you to know how to do it properly, take advantage, and be yourself and do the best you can while in the market. That being said, there's something else I'm going to talk about, which is trading without proving a point. A lot of people want to trade today because they want to prove a point to someone else that they are a better trader, or they can trade to make money move, or they can trade to buy Rolls Royce from trading, or they can do whatsoever it is. But let me tell you, that's not it. It's far away from that. Trading as a business, it's really, really far away from that. The only competition you have is yourself every single day. You are not in trading business because you want to compete with anybody. You are not in trading business because you feel like you can be better than someone else. You are in trading because you want to make a life out of it. So if you're ready to make a life out of this, you shouldn't need that motivation to remind you constantly why you jump into this endeavor in the first place. I'll talk about acceptance of potential outcomes, whether it's profits or losses. You are already in the game and you are ready to take full responsibility. That is you having the right mindset in the market, understanding how your fear, greed, fear of missing out, emotion, euphoria can be put together. Put them together in a way you can manage them. Understand that you're not everyone in the forex market. Like I posted sometimes today, that no matter how much you spend on eyeglasses or on your eyes, there is no way you're going to see from the same perspective with everyone else in the market. No way. Because the market is too big, dynamic, complex enough for everyone to sit down and rest and spend the rest of our day on a chart, analyzing, fathoming, putting together, simplifying what is really going on this chart. My thought process will definitely be different from yours. In fact, we may come to an agreement on the same bias, but our thought process will be different, if you must know. So this thinking process in forex trading, as analytical skill is concerned, is more or less like a DNA. As much as you see your thumbs, your fingernails is uniquely yours, so it is on your tongue if you are not aware. So it is on your tongue, your taste bud and all of those things, it's uniquely yours, just like your fingerprints. In case you don't know, I know certainly you may not know that. So it is when it comes to forex trading. Your thought process will just be uniquely yours. You realize you are the only one doing this thing the way you are doing it. You may tell it to someone else and they tell you this doesn't make sense. Okay, but it makes sense for you. And it makes sense to you. If you make money with this, it makes sense. Please go ahead. Keep doing what you do. Do it better. You are not everyone, and you shouldn't act like one. You shouldn't like you are everyone. Because you're not joining the bandwagon doesn't mean you're on the wrong path, but you need to understand what is critical to your growth in the path you're following. You should focus on what works for you. Like I said, if the ideology, the strategy, the approach that you are using is working well for you, you shouldn't listen to anyone else tell you otherwise. Because when they make their money and you make your money, the forex pays you. It doesn't matter if you are earning in dollars, if you're earning in pounds or in euros. What really matters there is the market pays you. So forget about everybody. You chase your bag and you get that comfortability you really deserve and desire. For you to really have all of these things I've said, you have to come out of your comfort zone. A comfort zone is a dying zone at some point. Not necessarily you stepping out of your stepping out of your sitting room or your living room. I'm not saying you stepping out of your compound or stepping out of your state. I'm not saying you must leave Nigeria and go to UK or Cyprus before you make a living. I'm not saying all of those things. I'm not saying you should relocate from Lagos and go to Abuja. No. What I'm saying is far way heavier than that. Heavier than that. I'm talking of, most importantly, your mental state, your mental approach, your mindset. You have to step out of a comfort zone. Stepping out of a comfort zone helps you to explore more, understand better, expose you to something better and more in the market. So this one particularly, it helps you. Can you still hear me?
Clearly.
Yes, sir.
All right, that's very good then. Thank you for your response. Gimbia, so sorry, I just remember something now as I saw your name. I know you know what I mean. I will try not to disappoint today, okay? I have a lot on my table. I will try
Okay,
as much.
sir.
Or are you on the chat right now? I think I could have actually done it a few minutes ago. I just closed a trade. Are you on the chat? Okay, once we are done with this class,
Yes.
I will put you through, okay? I will put you through.
Okay.
Yeah,
Okay,
I'll
thank you,
put you
sir.
through. All right.
Okay.
Okay, so probably I think it would be better for me to even do a screenshot. Most likely, I think that would even be better. The problem I had is to actually record and send and edit and cut out all of those unnecessary icons. I think I can. Don't worry, I'll fix it today. Or you can you do well to chat me after the class? You will have my contact from the WhatsApp group.
Okay, I'll do that, sir.
Please do, please do. I can't forget that way. Please do. So it will be easier for me. All right, thank you.
Okay,
Thanks for
thank you.
joining. You're welcome. Michael, good to see you. Olale,
Thank
good to see you. Daniel, good to see you too.
Thank you.
All right, you're welcome. So stepping out of your comfort zone as people, it is very, very important. Beyond being a trader, beyond being a pastor, beyond being a military man, beyond being whatever you want to be, whatever profession you sit to be on, it is important you step out of a comfort zone. There are so many skit makers you know in Nigeria, but you know the top 5. What simplified them? What exempted them from the rest? That's it. There are so many people that are wise in the books that you know, but why are some people you can't forget their name in the history? There are so many writers that you've heard their name. Why are some people you can't just talk about writers without mentioning their name? Even by the time you say one or two quotes, you realize that these are the guys that they wrote the quote. Why? There is no greatness outside the context of you stepping out of your comfort zone, because something good may not really come to you where you are sitting and enjoying. So trading is more or less like that. You have to learn. There are things you need to learn that is not coming to you. You have to go forth. Go to places you can find them. You may need to go online. You may need to reach your mentor. You may need to ask questions. These are things that are not easy for you to do. Stepping out of a comfort zone has a lot to do with you and your growth. Then the winning questions. Very simple. What are those things that you should be doing that you're not doing yet? Because anything that is working, it means there are certain things you're doing and a couple of things that you're not doing. So if you think that you have been doing some things and it's not making the right, it's not giving you the desired result, it means you have to change the approach of what you are doing. Whatever it is, be it a strategy, you're entering on 1 hour time frame and you're waiting for the market to move. In fact, you are so patient and you waited for the market to move like a full day. Second day, the market is still giving you a drawdown. On third day, you out of annoyance, you close the trade to get out of here. That's how trade can treat you. That's how trade can make you feel or reason or act. It is very, very easy for you to grab that, right? Because that's relatable for every trader. You tend to just do things out of like, I'm just tired of this thing. I beg, close this trade, man. Why? Because probably you are tired of waiting. You will hear things like, if you are ready to give me the profit, give me the profit. If you are ready to give me loss, give me loss. But stop hanging around. I hate seeing you hanging around. That is you talking to the chat. And before you know it, you're going to close that chat and you will rest. So basically, it comes from just two questions. One, what you should start doing. What are those things? The second question, what you should stop doing. What are those things? So what are those things that you should stop doing? Well, I jump into the market in the morning. I trade. I probably trade the US dollar, Euro USD during the during the Asian session. If that is not working, then you should stop it. There are many reasons for you to stop it. You should stop it. Okay, every time I trade, I use my support and resistance and RSI and candlestick formation patterns to determine if the market is having a high probability setup for a buy or for a sell. That is the reason I've been trading this way, and it's been working for me. Good. If that is working for you, you keep it up. If it's not working for you, no matter the energy you put in it, you have to drop it. If you cannot drop it, you have to remodify. You have to enhance it. You have to redefine. You have to refine. Come on. This thing is not that easy, but you need to have these winning questions. Like, these are the questions you need to answer for you to win. These are the questions you need to answer for you to progress. And it goes beyond trading. One good thing about my classes is we can't settle only for trading. If you have been listening to my class, if you have been in my class for a couple of times, you can tell. The ideas I share are beyond trading world, because the market is not about the price, it's about you. There are certain things you can't do in this market because you don't not understand yourself yet. Have you been on the chat today? Have you seen the analysis we made on Sunday night? Have you seen how they're playing out yesterday and today? I can show you, I still bought USD card, not quite long. I jumped out of that trade probably before the class, or a few minutes after the class. I jumped out of the trade in profit as well. I could tell this is where I'm expecting the market to come to. I could tell this is where I'm expecting the market to get to. This is where I'm expecting to jump out of this market. I may not be 100% right every single time. It's normal. But the fact that you can tell that this is the decision, this is the bias, this is my thought process, and this is how I'm executing it, and most importantly, this is how I'm going to embrace the outcome, this made me a better trader. If you have been on the platform, you would have seen what I've posted today. You can go back in time, check all of those analyses we've done for the past 3 to 4 months, check every single week, week in, week out, 4 weeks or 5 weeks a month, check them out. Go back to the market, back test, confirm what has really happened. I was tired of showing proof of how the market has gone in our favorite direction or not, but that doesn't mean the market has not been doing well. So basically what I'm saying is, for you to win, it's beyond even on the charts. You have to win in person. The market is not about the price. The market is about you. If you do not understand yourself to that extent, you won't understand the market to that extent. So there is a level of clarity that you will need in the market that you will never have if you do not understand yourself. And that is the only reason that you can analyze the market on the demo account. And when you get to live accounts, you won't be able to have the same confidence to enter the same market on demo accounts. So you realize after 2 months, you've grown your demo account by $200, 200%. And your live account is still on 0.09%. Have you noticed this? Who has noticed this? Is this you? So talk to me. Unmute your mic and talk to me. Unmute your mic and talk to me now. I really want to hear from you. Daniel, is that you? Have you encountered that before? Gimbi, have you encountered that before? Michael, Olale, have you encountered that before? You do well on demo accounts, and on live accounts, you perform lesser.
Yes, sir, that's me.
Gimbi, thank you for the response. Okay.
Well, on my side, I've never traded demo before. I started live immediately.
live immediately. I love that too. I love that. What about you, Michael? What about you?
I've not experienced that. I've not started the live trading.
Okay, but you've started demo, right?
Yes, sir.
Okay, great. Keep the record of your demo account. And when you start the live account, put them together and contrast. All right. So
Okay,
very
sir.
good. All right, great. So this that we have shared today, it's a practical experience for everyone. Mr. Lale said something. He said he has never traded a demo account. He started with live account. I have students like that too. I asked one of them in those years. He said, I will never feel the pain of losing $1 on a demo account. So I had to go to live. I said, wow. So we are different from each other. And I think I can address that. I had a student sometimes in 2017, 2018, I think 2018. She traded a demo account. One of the nights she called me. All through the night, she was calling me. I was like, oh, come on, this is not official hour. Why are you calling me, this woman? So I didn't respond. I waited the following morning. And when we got to see in the class, she was like, she had called me. I said, I saw your call. Over 24 missed calls. What happened? You could have dropped a test. What happened? She said she had lost, she's losing an account, she's losing a trade, and all of that. Like, okay, so sorry about that. How much was it? She says around $6. That alone was piercing to me. Like, wait, because of $6, you nearly called me out of this world. Like, really? $6? And I said, yes, now. Okay, can I see your charts? Let's see what happened there. Lo and behold, it was a demo account. I felt so bad. I was humbled. I kept quiet. I muted for a minute, like, why will you do this to me? Why will you do this to me? I was thinking it's kind of big account, like maybe she has lost $1,000 or something. And on top of it, it was a demo account. I said, Madam, do you realize this is a demo account? She said, yes. I said, so you are losing $6 on demo accounts. You are calling me. She said, yes. I said, but why? She said, I told them something in class that if you're able to manage your demo account the same way you manage your live accounts, that your life will be easier as a trader. That she kept to that word. I said, okay, now I understand. So where I'm going with this is she treated the demo account as if it was a live account. It may be easier for her when she gets to the live account because the psychology, we only need a little bit of reinforcement. But you see, there are traders that do not care about these things. So long it's a demo account, they trade it anyhow, like anyhow. They just trade it anyhow you can. It's the demo account. I have nothing to lose. And that attitude of I have nothing to lose is what you cannot sustain when you get to a live account. So there is a way you're going to see a market now. You're going to trade it anyhow to make money. But the way you traded it anyhow may not be allowed on a live account for you to make money. On a demo account, you can have minus $300 out of $1,000 you funded your demo with, and you can still close the trade in profit of maybe probably $300 profit. But on your live account, when you fund $1,000, is for example in this economy, close to 1,700 per dollar now, so that's around 1.7 million, right? So you fund with 1.7 million, you want to gamble. Why? Why? I don't understand. Why will you gamble, by the way? So you really need to know, understand exactly what you want to do. So this is not the time you want to trade anyhow to see minus $300 before you see the market coming back into profit. You may not even have the chill rather. You may not even have that patience to see the market going minus $100 against you. And right there, something is shifting. That's when you realize there is a huge difference between a demo account and a live account. So at all costs, it's important you focus on that live account very, very carefully. If you're on a demo account, treat it as if you're trading on a live account. I had a student sometimes in 2020 in Delta State. He was trading on a demo account. He was trading on a live account. He thought it was a demo account. I was training them on how to use RSI, MACD, and one other indicator then. So he was just putting everything into test in class right there. So the following morning, he wanted to show me that the market moved well based on the indicators we shared yesterday and all of that. He opened his chart and he shouted in the class. He kept shouting. So what happened? We figured out at the end of the day, he placed a trade the day before. He placed a trade on a live account with a huge lot size. And he was thinking it was a demo account. So all through the night, he left the trade to run. So the trade ran till the following morning when they came to class to see me, only for them to realize that the market is running on a live account. It closed more than $700, I think, from that trade. I think it closed more than $700 from that single trade. Well, had it been it was a live account, it wouldn't have traded that much. So, which means the act of recklessness in trading a demo account that was unconsciously introduced and executed on a live account acted as a blessing to him in that time. I bet he will not do that again. He was never going to do that again. So, what am I saying in essence? There is a certain way we can analyze the market on live accounts or demo accounts, and we can come to live accounts to do the same. But the emotions, the psychology may never be the same until we try to reinforce it in that perspective. We'll talk about the risk reward ratio. This is called RRR, risk reward ratio. The risk reward ratio, sorry. Okay, the risk reward ratio entails how much you're willing to lose and how much you're willing to make. How much are you ready to lose on a trade and how much are you ready to make on a trade? So for instance, for example, if I'm taking a trade based on analysis and I'm looking at the market and I'm looking at the chart, I'm saying, okay, if I'm buying from this price level at 1.2170 and I want to buy and I can set 1.2160 as my stop loss, that is 10 pips stop loss. I can equally still be the same guy that will tell you that I'm expecting to make 50 pips from that trade. I'm risking 10 pips to make 50 pips. That is 1:5. So the risk right there will be 1 and the reward right there will be 5. So that is the ratio. So how are you going to calculate this? Depends on your equity size. Depends on your capital size in the market. If you have $10,000, the way you're going to trade must be different from the guy trading with $500. So you're going to trade with the lot size that goes with your account size. I do tell people, what lot size can you use to see the market go 50 pips against you without you sweating? 50 pips is a lot. But what lot size can you use to trade that against you without you breaking sweat? If you figure out that lot size, then you can use. Anytime you open a position, do not risk more than 1%. In fact, I tell people 0.5% is enough for you to risk on a position. 0.5% is enough. So if you are risking 0.5%, the first time, second time, third time you lost on that trade, then that is 1.5% you've lost on your account so far. That's after 3 consecutive losses. Now, if you're making 1 win, let's say you're still trading the same way, 1:5. If you're making 1 win, you're going to recover all the losses and add to it. So if I've lost 3 times now with 10 pips stop loss, for example, that means I've lost 30 pips, so to say. On 3 trades, I've lost 30 pips. If I'm going to make a profit with the same strategy, 1:5 on my analysis, I will make 50 pips profit. That is my take profit right there. And 50 pips, taking away my 30 pips of recovery from that, I'm still having 20 pips extra. So what happens when I trade like that 3 times consecutively to make profit? That means I would have gotten over 100 pips. And with that, I can play around in the market and trade with low risk. Even if I'm losing again, 10 pips, 10 pips, 10 pips, even if I have to lose 4 times again, that's just 40 pips out of over 120 pips I've made. So you tell me at the end of the month, how am I not going to close in profit? Now you see, that's the power of risk reward ratio, and that must be calculated based on your equity side, based on your capital. Then we have the instrument that you trade. Not every instrument is suitable for some account sizes. Some account sizes are too small to carry some instruments, like gold, for example, like Bitcoin, for example. You can have $100, $200 account size, and you expect to trade very, very well on gold, only if you're ready to gamble. And a lot of traders gamble that. Why? Because with the lowest lot size that you can see, when the market moves 50, 100 pips against you, you can easily lose even close to 1% of your account. And that's it. The instruments that are very, very low in volatility are those like Euro US dollar, for example, Great Pounds US dollar, for example, AUD USD, USD CAD. They're all good. I'm not saying those are the things you must trade, but I'm telling you to research more on the instrument you're trading and relate that with your account size. Understand what is swap, negative swap and positive swap. Understand the direction of the trade you're going. Understand the direction of negative swap on that trade. There are some currency pairs you're trading, they are negatively, they have negative swap. So each day you leave the market to run over the night, so another trading day, you'll be charged. So imagine you are being charged, let's say $12. Okay, let's just say $5. $5 every night, $5 every night, $5 every night, and you let the trade to run for an entire week. You calculate that. Give or take, you must have been charged $15, give or take. So when you're closing that trade, even if you make $50 profit and you want to close it next week, the $15 that you've been charged for the swap will be taken out of the profit that you've made. So 50 minus 15, you'll be having 35. So your profit as at then will now be $35. That is just a scenario, a case study. It could be more, it could be less, but I'm telling you the impact of negative swap. So it is better that you trade in direction of the market that offers you the positive swap. If the trend direction goes in that way, it is good. If not, you still have to obey the trend direction. That is it. Because with with positive swap, even if you have not made money from the trade itself, the positive swap you've made over the nights would have amounted to something at the end of the day. There was a year, I think it should be 3 years or 4 years ago now, I was trading Great Pounds US dollar. As at then, when you are selling, it will give you positive swap. And for that reason, I was on that trade, I think for 3-4 days thereabouts. Yeah, I can't remember. But then I was accumulating positive swap. So when I closed that trade, I closed the trade around probably maybe $87 thereabout. I closed the trade on 2 digits. And when the swap was added to it, I was saying 107 thereabout. So which means the amount that was added to you was significant. So basically what I'm saying is understand the swap of the instruments that you are trading. That also goes a long way. We have 12 more minutes and it seems we just started 5 minutes ago. The instrument average daily range, which is called ADR, also matters. For example, you love to trade USD CAD, for example. And if the average daily range, this means the number of pips this market runs on a daily, on average, like 70 pips, buy and sell, 70 pips in a direction, buy and sell every day. If this market has done closely to that amount, then why are you bothering yourself to enter that trade again for that day? Only if you're expecting a fundamental outlook to push the market in whichever direction. But aside that, come on, that may not be feasible, that may not be nice, because the market is about you understanding what to do at the right time. Okay. You should avoid low probability setups. Come on. You should avoid low probability setups. What are the low probability setups? The analysis you made, and you're looking at the market, you're looking at it from a point of view like, it seems the market will go against me. Even you can tell. It's looking like the market will go against me. I'm not too sure yet, but it's looking more like it. That is a low probability setup, definitely. When you are seeing the market that it's not a particular direction, for example, when you are trading against the trend, it's a low probability setup to start with. That is counter trade. They call it counter trading. It's a low probability setups because the market can just be really ready to continue moving in the explosive manner of the intended swing that follows the trend direction for that asset or for that instrument. And what if you are caught in opposite? For example, you're trading gold for a sell and the market has been on a very massive bullish momentum for the past months and you are selling. The sell may just be okay within 2 hours or 3 hours of the day. And trust me, before the day will close or the following day, market will do ×3 or ×4 of the entire movement of the sell. So how much have you really made from the sell? 100 pips. and gold is here to do 400 to 500 pips against you the following moment. So avoid the low setups, embrace the high setups. Low probability setups and high probability setups are two things in the market. Successful traders, you should do more with the high probability setups. All right, let's spend the remaining 5 minutes on the chart and let's see what we can do with that. Oof, I'm coming. I want to stop sharing this guy. I want to share the chart really. Okay. Look at this. Can you see my chart now? Can you see my chart? Can you see my chart?
Yes.
All right, thank you. So, for example, on this chart now, for instance, look at this. Forget about how I got here. All right, I've explained this in the video of the analysis on Sunday. I was explaining particularly that once the price of this market gets above this high and close below it, expect more sell. So when that happened this morning, my immediate take profit level was here. Look at this price here, 1.3540. Can you see? Can you see? I know the price because I've been talking about the price for a long time. This low here, when the price was here, I already saw it. I went down to even 45 minutes, 15 minutes to confirm that this is looking good for a sell. Look at it. All yesterday, the market was doing all of this sweeping. Why? Because the last low before this internal range was here. Look at it. This is the low. When the market does something like this, just to clear people, it means a lot of people want to sell. So these sell stops. People ready to sell because they expect the market to break through here, turn this level to a resistance. Yes. They expect the market to break through here, turn this level to resistance, and continue selling so that the market will come to this price level next. Yeah, this is their chart. But what the market did was different. Market came here to clear the price and move back upward and close above it. Immediately the market closed above that level, I was anticipating it to come here. The moment it broke through this level, I was waiting for just one thing, either to retest and break through the previous high of that break, or to come back into this level and continue selling. If it's going to continue selling, I already marked out where I'll be expecting the sell to get to, which I just showed you, the week of this low, 35.40. And that's it. So market dropped all this way. I showed you this chart in the morning. Market dropped all this way. That's more than 60 pips from where I think I even showed you from. More than 50, 60 pips. Look at it here, 62 pips thereabouts. So in all of this, where am I going? Where am I going? Depends on how I analyze this market. Depends on how I analyze this market. So particularly, what if I had said, this was my entry point above this high, and above this shaded level is my stop loss. So let's calculate that. That would have been 28 pips. So if this level is my stop loss and this entry is my take profit, but basically I do not take my entry from there. Someone like me takes my entry from the middle points. So which means above that level, even if I'm going to take it, it would have been around this middle point of 13636. For that aside, let's make this simple to where we can see, obviously, this is the line I'm expecting to be broken before I jump in a sell. So let's even say I'm using this line as a sell limit. So the market would have gone only about 30 pips against me for me to lose this trade. And what if my stop loss is just about 30 pips and market moved just about how many pips against me? Market moves 24 pips against me, which means it does not hit my stop loss. And from there, the market started selling. So from here to where the market sold to, come on. This is 90 pips. 90 pips while I was rendering how many pips? How many pips again? Let me show you. Our time is almost up. Well, I have to show you this, okay? So pay attention. See this. If this is my stop loss here, and look at where the market is now. Can you see that? So what would this have been? What would this have been? Those have been 1:3. 1:3. Why? I was risking about 30 pips and I was making about 90 pips. So this is 1:3. So if I've traded this way, trust me, if I have traded this way, with this trade alone, if this is my profit, take profit, and I close in profit here, trust me, if I'm taking another trade and that trade goes against me to hit my stop loss, I would still be in profit because I've made 90 pips here. And the next trade, I'm losing just 30 pips. So I'm still having 60 pips profit left. That is the risk reward ratio. So what will inspire this or determine how many percent you'll be looking at is the integrity and the knowledge you have in your technical analysis. There's a way you can analyze the market. Sometimes I've used 3 pips stop loss before, I've used 5 before, and the market did not hit any of them. Do you get me? So which means there is a way, and I've used 10 pips, 20 pips before that the market got them hit. So let's be clear. So what I'm saying in a sense is the analysis you make will determine the level of risk reward ratio you're going to have. So it's not every time you will have 1:2, 1:3. Sometimes I've had 1:9 before, 1:10 before. You can analyze the market and you can just sacrifice 10 pips and the market goes ahead to give you 100 pips. That's 1:10. But I'm not saying you should wait for 1:10. Start with that 1:2, advance to 1:3, advance to 1:5, and that's how you're going to get better. Ladies and gentlemen, thank you very much. This is where I'll be stopping for today. I think I've helped you in regards of the psychology and your risk management. If you have any question in the next 3 minutes, please go ahead with your questions and I'll be more than happy to answer. Thank you very much. I'm waiting for your questions.
Please, I want to ask about this average daily range. I was struggling to hear you because I'm battling with network from my end here. So please, can you just use the remaining 30 minutes to lay more emphasis on it?
Okay, good then, good. So basically, it's an indicator on your MT4 and MT5 that tells you the average movement of the currency pair in a day. For example, look at this guy here. Most of the times you've seen these candles here on the USD card. You've seen they've been maintaining a particular amount. If you notice, like it's more or less like a size like this most of the times. Exceptional time is when you have a long candle or you have a very tiny candle. But most of the times within a pattern or a structure of a time, there is a movement that can be judged based on random or based on average movement. So when you calculate, it's more or less like in a day, calculating this has done how many pips in a day? 46 pips in a day. The following day, calculating the entire buy movement that it did, it was about 45 or 41 pips. Following the other day, this is about, I'm coming. This is not cooperating with me. I'm coming. I want to calculate this. Okay, this next candle here, this is about 31 pips, right? So at least on a random note, you can tell that this market will do definitely, it's going to do more than 20 pips in a day. On a random note, you can tell that this market will do more than 30 pips in a day. So that's what the average daily range means. So it's about how many pips can a market do or a currency pair can do in a day. At some point in time, even US dollar will do around 60 pips. While Greek pounds you do around 80 to 100. At some point in time, they change. So it's about the volatility in the market based on timing. So look at this, for example, too. From this price level, the market sold how many pips? About 50 pips. The following day, how many pips? About 50 pips too. Look at it, about 50 pips. The following day, market sold about how many pips here? I'm coming. This guy is not cooperating. Okay, this is about 25 pips thereabouts, which is way lesser than the two guys, isn't it? But then, as I said, it's not every occasion you have the same amount, but based on random and average value, you can always get. And for example, you can calculate for weekly outlook, for weekly candlesticks rather, If you check the weekly, it's more or less like you're saying the total number of pips made on Monday, on Tuesday, Wednesday, Thursday, Friday, calculate them, sum them together, divide them by 5. You're going to get the average. Do you understand that? So the same thing you can do for monthly time frame. You can do, if you want to do monthly, you're going to calculate the weekly candles. You can divide that by 4. It's just a way of knowing how many pips you should be expecting in the markets per time, either per day or per week or per month. I hope that's clear.
Okay, sir.
All right. Okay. Any other question from anyone else?
So will this record be? Will it be recorded? Because the past
Yes, yes.
the past lectures, if not posted the recorded session.
Oh, okay. I posted one yesterday though. Someone asked for yesterday's own. I posted it. I was thinking you were going to ask. Someone posted for yesterday. Someone requested for yesterday's own. I posted it, so it was recorded and it was dropped in on the WhatsApp group. And today's own too. I'm going to drop it there after the class. Okay. A quick expo on the USD card in the future. When they start buying, wait for the market to get to this price range. You may find a juicy sell opportunity right there, like this. Okay. Okay, this is by the way. Ladies and gentlemen, thank you very much for coming. I'm blessed to have you. The moment is very special to me. I'm not taking it for granted. And this is where we're stopping today's class. And this is the end of the advanced class for this week. And I wish you all the best. If you have questions, please do it to ask your questions, and I'll be more than happy to answer them. Thank you very much. Enjoy the rest of the evening and talk to you later. Bye for now, and God bless you.
Bye.
Thank you, sir.
Thank you. Cheers.